Hey, good afternoon, everyone. My name is Anna Griggs, and I'm the Director of Marketing at Coleman Report. It is my pleasure to welcome you all to today's webinar, Mid-Year Banking Briefing, Policy Shifts, Market Resilience, and What's Ahead. Today, we're joined by a fantastic panel of experts who will discuss the current landscape and what we kind of have going on. So first, we have Josh Siegel, CEO of StoneCastle. Next, we welcome a new face, Paul O'Connor, Managing Partner, Anchor Strategic Advisors. Joining us also, we have Michael Mancusi, Partner at Arnold & Porter. And lastly, we're glad to have John Winnick, CEO of Clark Street Capital, who set this all up and will be moderating today's discussion. Just a few housekeeping items. Our experts will cover a variety of topics throughout the webinar, and the best way to bring a question up is to use the chat function up at top, and John and myself will be moderating those and bringing them up when it's appropriate. And also, this webinar is going to be posted on the Coleman Report YouTube channel after this. So if you need to step away for a second or want to review anything, that will be there for your viewing pleasure. Thank you once again to both our audience and our panelists for joining us. We have an exciting and informative session ahead. So I'm going to turn it over to John to get us started, and I will switch the PowerPoint over.
Great. Thanks, Anna. Well, we're going to start with the topic that everybody is talking about in the banking industry. If you could pull up the slide, the Pinnacle and Synovus merger. We're not going to go through too much of this, but basically they're going to create a $116 billion bank. Go to the next slide. You can see Pinnacle has been, quite frankly, the better performing bank. But Synovus has done well as well. Next slide. Next slide. A couple transaction highlights. This is very much a merger of equals. The ownership is going to be 51.5 Pinnacle, 48.5 Synovus. From a leadership standpoint, they basically went position by position. Although some of the Pinnacle executives are going to retire, so it does seem it'll be more Synovus leadership. Board of directors, 8 and 7, 8 Pinnacle, 7 Synovus. They're going to do a split corporate headquarters, and they expect to close it in January. Next slide. I mean, it's clear what they're trying to do here. The big win here is assembling this pretty strong southeast geography. Next slide. You can see they're in a lot of fast-growing growth markets. That's probably the biggest strategic rationale for this. Next slide. And they still have room to grow. You could see Pinnacle is #1 in Nashville at 15.4%, but plenty of room to grow in these fast-growing Southeast markets. Next slide. And there's not a whole lot of overlap, surprisingly, between the two institutions. So the carnage, if you will, in this deal from an employee standpoint probably won't be as bad. Next slide. Paul, maybe you can go over some of the financial assumptions. Curious whether you think this is comparable to other deals.
I thought the marks weren't that bad. I mean, the loan credit mark, was about 1.1%. You've got 10% cost savings, so that's not a huge amount to overcome. I think the one that may come as a surprise to a lot of people is when you're valuing a lot of the loans, it's not just a credit mark, but also an interest rate mark now. And I've seen that screw up more deals than the credit mark. I mean, credit marks are generally easy enough to understand and to valuing interest rates and the length of time these loans are going to be outstanding has become much more difficult. I think the one interesting thing here is they're going with the compensation model that Synovus has, which is much more, earn what you make. So, it's a very much of a pay for performance kind of style, a little different than most banks in the industry.
Next slide.
I think, again, the core deposit intangible at 2.4% didn't wasn't that surprising. They've got a nice wealth intangible at 197 million. Again, when you're looking at a $116 billion organization, these aren't really all that big in numbers. I mean, they're not going to change the dynamics that dramatically. I mean, what I took away from it was, the tangible book value payback period was 2.6 years, I think it was, and earnings per share are off. I'd have to double check my numbers, but I think it was 29%. I mean, those are big numbers, for anybody, that's looking at these kinds of deals. 21% earnings per share. Sorry.
So I had the opportunity to talk to a number of bank CEOs, confidentially and privately, if you go to the next slide. And I would say the reaction has been mixed. You could see here what sort of drove this. There was this sense that Pinnacle was looking to sell. They couldn't get acquired by somebody larger. And so the MOE became the next step. If you go to the next slide, some good color from so some of these quite difficult. One of the CEOs said, I don't think it's a good marriage. They're going over 100 billion without being prepared. The market spoke pretty clearly on what they thought about it. There's too much execution risk. Another Midwest public bank CEO was a little more nuanced. He did sort of point out, while MOEs don't have a great track record of success, this does allow two companies to catapult over the $100 billion threshold. Of course, this didn't go so great with NYCB Flagstar Signature, so the market skepticism is expected. In summary, the market is skeptical and taking a show me, wait and see attitude towards the deal. All that said, both companies have really good people who are capable of executing well. Josh, Michael, what do you think of this deal?
Josh, you want to start?
Yeah, sure. Yes, merger of equals, but I think it was a merger of two institutions who were stuck in the netherworld. What was the path forward? How are you going to delineate yourself? What's your specialty, right? So if the only differentiation at its core was geography, then it's very hard to figure out how you're going to go from 50 billion to 100 billion organically. And so I think there are probably several other bank combinations that will look like this that we'll probably have to see in the coming years, because I've always been sort of a stalwart on this point of the regionals are the most challenged of the groups, and that tends to be the regulatory view as well. You're too large to really be a connected community bank, even a large one, and you're too small and subscale to compete with, Wells, B of A, US Bank, et cetera. And so I think they have to look toward something that allows scale to build, footprint to build, to get closer to their larger brethren. So I think it was necessary. Did it have to be these two? No, but it does kind of look like the right footprint with not a lot of overlap. I agree with some of those slides. So directionally, I think it needed to happen, and it's probably not a horribly bad combination.
Yeah, there's a couple points in there to flesh out a little bit. First you said, they crossed 100 billion. They're trying to, make sure that they're able to, essentially play in the same sandbox as the really big banks. But, when you look at the Southeast, and the slides earlier showed, the combined entity is the fourth largest bank in the Southeast. But when you look at it, they're still half the size of number three. And actually a little bit less than half the size of number three. So it was a move that I think, as Josh said, was necessary to help them, remain competitive in that end of the marketplace. But there are also some other intangible things that we have to keep a close look at, and how this plays out. The mergers of equals are difficult to accomplish for a number of reasons, not the least of which is the cultural integration. the business operations integrations, those, banks have handled that kind of integration fairly, most banks fairly easily over the years with these transactions. It's the social and cultural issues that I think where we find banks struggle in mergers of equals. We have in this case too a split, virtual split in management and the board of directors. So, it's really going to be taking a careful eye and looking how the regulators are managing the integration process and how the two institutions are managing and integrating their cultures, and will that be successful? What's also, I think the market is going to wait and see how this progresses before everyone jumps in the feet with, into the pool with both feet. Because they want to see, I think the industry would like to see how, and we'll get into the new administration and how that's impacting the regulatory agencies, but how they proceed with caution or maybe with abandon and on these types of transactions under the new administration. So there are a lot of things that are unknowns. I think that's a theme in today's banking industry. There are many unknowns.
Yeah. Well, it sounds like the negative market reaction. Could that mean, Josh, more deals or less? The reaction obviously could mean less deals, but, perhaps that encourages other people to combine.
Well, negative public reaction, it really depends on your lens as management. Having run a public company myself in the past, I always maintain the view as shareholders, control is a very strong word, but I try to control the earnings. I try to control the credit quality. I try to control things I can control. I can't control the stock price. Right? That's a market issue. And so I always asked the market to just trust and believe in what we did, and they did, but I can't control that. So the market reaction to two banks that were doing okay, treading water, combining, I think it's a lackluster response. It's not a bad response, right? They're not saying, oh, well, this is going to destroy both franchises. That's not how I read the tape. But I think without mentioning other regionals, they're going to still face this challenge of what are my options? And it's kind of like that movie Argo. It's my best bad option. They're going to have to say, okay, my stock isn't doing great anyway. Do I at least have more runway forward if I combined? So I think that the market reaction is not going to dissuade others that are stuck in a similar position from trying to make some hard choices.
Paul, Mike, can mergers of equals work, and when do they work?
I'll talk to you because I've been involved in a couple of them myself. And the interesting thing is the top of the house can get along. It's the middle managers who they believe is giving them the path forward. And that's where I think this is going to have to be communicated, because you've got two separate headquarters. You've got essentially a management team in waiting, right? So, a couple of 70-year-old guys are going to run it who've done a really nice job historically. Now you've got younger guys taking over with kind of a different philosophy, management philosophy from a pay for performance standpoint. I think if they're able to understand and to communicate well to the, Pinnacle people, I think then it's going to work out okay. And I think Synovus, you've just got different philosophies. And I think that's going to be how they integrate those will be the key test of this. And if his history is a telltale, it's probably not going to work out well.
Yeah.
The only thing I would add there, John, is it can be done right. I've seen it done right once before. The only way it works right is fast, immediate pink slips. In other words, I'm just picking random departments. Okay, C&I, Pinnacle team's going to win. Leasing, right? And you just have to just say, okay, I'm not going to try to merge groups. I'm just going to keep the stronger of the two, and I have to get rid of the other one. That's where I've seen that work very well over the last 30 years when you have mergers of equals. If you try to actually, inside a single department, meld the two teams, that rarely works well. You just have to axe the lesser of the two, and then you move forward.
Yeah. I've had some conversations the last few days with bank CEOs regarding this, and a few of them brought up the Comerica situation. Comerica had an earnings call a couple weeks ago, and one analyst basically said, look, your stock price hasn't moved in 25 years. How are you okay with that? Then Mike Mayo piled on, and then there was a research paper put out by an activist investor last week, really pushing Comerica to sell. I mean, it sounds like the natives are getting a little restless out there, doesn't it?
It does. I mean, when I look at any of these regionals, and some of this is from firsthand experience dealing with senior management, the hardest challenge that senior management seems to have with any of their organizations is changing the culture inside their own organization. Nevertheless, trying to meld two different cultures. Without mentioning a name, but another very large regional in the Midwest have a very, very savvy commercial side of the house, right? Forward thinking, new tech, different approach. The retail side of the house has been completely obstinate in terms of upgrading technology, how they integrate. They refuse because you have a lot of senior middle level managers who are trying to protect their job, their team's jobs, and there's basically an infighting. And so getting the organization to modernize, to change, that's the greatest threat that these organizations have. And Comerica, I have some time working with them in the past. You know, there's decent camaraderie, but there's no fire in any of the people I've met at Comerica. It's basically, I'm going to go into work tomorrow, do what I did yesterday. I'm going to treat my customers well. But that's great, but you're not going to go anywhere. That's why the stock doesn't move. And so if someone can't take a radical approach to really upheave the organization in a positive way, then I think they're all going to be faced with the same issue that I've seen for the last 5, 6, 7, 8 years, which is the regionals are just lying. They're just melting away. They're like an ice cube.
Michael, Paul, are you seeing that? Are you seeing investors more impatient with management?
I think it's, it's very difficult to move these companies. I mean, you're $100 billion. I mean, to just grow, 5% is $5 billion a year without acquisitions. I mean, that's a big number given the competitive landscape that you're working under. I think, Josh is absolutely 100% right. I mean, whoever wins this, you're either going to be under the Pinnacle modus operandi or the Synovus modus operandi, and one side will kill the other. And every time I've been acquired, which is now 5 times, we've gone to bigger organizations that have just stuffed all the creativity that we had, and everybody left.
Yeah.
And I think that's a big issue. And the guys that are left, you kind of wonder why they're still there.
Yeah. I mean, it looked like, Paul, bank earnings overall were pretty good. Anything noteworthy that's worth highlighting, which you saw?
I would, I feel almost guilty for saying this, but I think bank earnings have been very good. Net interest margins have been pretty stable to improving. Probably the only thing I see out there that still concerns me, the AOCI losses are still significant for a number of institutions. And then one of the big things about M&A has been this mark to market of these loans when it comes to interest rate marks. And that number has been a much bigger number than I would have anticipated in a number of deals that at least I've looked at. And it's a big argument over, which guy is right. I mean, how long do single family mortgages last? Is it 7 years, 10 years? That's killed more deals or delayed the discussions in more deals than any other single factor. Price is almost not an issue at this point.
Yeah. Well, again, that's the point I've been making for a while. It's, I call it the great rate standoff, where since December of 2022, when rates started going up, there's been somewhat of a transaction strike because there's buyers who need to buy, with today's rates, and sellers who are nostalgic for the rates in the past. So things are just kind of stuck, right?
I get people telling me their bonds are AAA, and my response is absolutely. The issue is I can buy them today at, 5.5%. You own them at 3%. Which one do you want to have?
Yeah. So, these AOC issues, it just doesn't, I've seen a couple examples. Associated did something last year where they pulled the plug on 3% mortgages and 2% securities. But it just surprised me how little movement there's been quarter to quarter, except due to interest rates. Obviously, as rates move, those losses change. But it's just surprising banks haven't done more on this.
I don't know. Why is it surprising? They saw what happened to Silicon Valley. They ran for the hills.
Right.
It's like, don't do that again.
You think there's still sort of a hangover from scaring the market by taking losses?
Yeah.
Mike, are boards having those discussions in boardrooms? Or is it pretty much these are AA, AAA rated assets will get paid off at maturity? Let's just stand pat.
Well, I think certainly the discussions are going on, but these are the types of issues that, these are the types of discussions that go on in the boardrooms, and, how much of the portfolio do you, how much of your portfolio do you try and if, take these kind of hits, and how deep will the cuts have to go? And then, boards and senior managers are still scared of, what happened 3 years ago. There's still a hangover. It's hard to imagine that it's been it's been 2.5 years since that's happened. So it's, these are discussions that I think are happening all over the place, and I don't think there's not necessarily a right answer, but you need to at least have the discussion.
Yeah. Well, let's stay on you for a second, Mike. We on our pre-call, we talked about, I asked the question, is liquidity an issue? And you mentioned for the regulators it is. Can you give me some color on liquidity?
Sure. So I think for the most part, banks have done a very good job in shoring up their liquidity over the last 2.5 years. Most, I think, are confident in their positions, in their contingency planning and testing, so that they don't run into liquidity crunches. That said, there are still banks that are seeing deposit shifts, and the regulators are still heavily concerned about liquidity. The strength of your liquidity, the strength of your contingency planning and monitoring and risk management. So there's a lot that's still going on the examination front as it relates to liquidity. It may not be those risks may not be top of mind right now for a lot of the industry, but the examiners have not released their hold on it.
Josh, investors still worried about liquidity, or is that rearview mirror?
I think there is a bit of a canary in a coal mine cliche going on. I do know a number of, multi-billion-dollar banks that are seeing core deposits run off much faster than they would have expected in the last year or two. And so I don't disagree with Michael. I think overall liquidity is fine. The problem that I hear from most banks is finding very cost-efficient liquidity is very, very difficult. If you want to pay, like the broker sweep market, which is probably the deepest institutional market, right? We're talking in aggregate almost $1 trillion. That's Fed funds plus 25. Okay, so there's your benchmark rate. When it was really tight, maybe it was Fed funds plus 15. Wide, it's Fed funds plus 30. So that's sort of the benchmark rate. So if you want to find deposits at 2.5%, 3%, extraordinarily difficult right now. And probably not going to change anytime soon, because whether it's technology or fintechs or whomever, there's just much more transparency of what's available out there. And so it's very difficult to grow a deposit base with sub-market deposit costs, which is really what defined a strong organization, banking organization in the past.
Yeah. We have a poll question we'll start to pull up as we talk about regulation. Obviously, with the new administration, we're seeing some changes. Anna, can we pull up that poll question? How has regulation changed under the new administration? You know, we asked a similar question 6 months ago. Prediction, significantly less regulation, moderately less, no change, slightly more. One vote for slightly more. That surprises me.
Depends where you're chartered.
Yeah. All right, let's close this. Oh, the consensus, not surprising, is moderately less regulation. Michael, Paul, Josh, is that kind of your view, or where do you stand on this?
Yeah, I think that's right. I think we're still a little bit in a wait and see approach. You know, the senior most regulators are, you know, just now getting into place. You know, the controller was just has just taken a new controller has just taken over. Governor Bowman has stepped in her role for supervision at the Fed. We still have an acting chair at the FDIC. So, you know, I think there's still going to be some time for things to shake out exactly how the Trump administration's deregulatory push, how quickly it's going to come into focus, and then how deep those will, you know, those changes will go. I mean, on one extreme, we've seen how quickly they've taken down the consumer regulation. Interestingly, there's a proposed executive order that is now saying that on the debanking issue, that the administration now is going to use consumer protection and to help thwart debanking. So there's a little juxtaposition on how the administration has approached consumer protection from the first part of the administration to now. But I think it's more. It's not. I think to me, it's obvious. It's results driven, and the administration will use whatever buzzwords that they can to try and achieve the result that they're looking for. So it'll be. I think there's going to be a disjointed approach on the deregulation. It'll be interesting to see how each of the new heads of the agencies, you know, shepherd their organizations forward.
Yeah, I mean, John, I have two main thoughts on this. I don't see that the regulatory direction has actually changed much. It's more of regulation by omission. You're just not seeing regulators taking actions the way they did before because there are so fewer of them. Literally, there's been a gutting in many. So a negative to that is there are quite a few organizations under sort of Operation Choke Point who had, you know, BSA OFAC violations. There's no one to lift the order. They're just stuck. No one's picking up the phone. And so you have sort of a looser environment only because no one is enforcing. And that's different than changing the direction of regulation, which is still talked about, but I haven't seen that affected. The other comment, I was always a bit critical of CFPB from its start. I think it had a good aspiration, but it really just became a pit bull nipping the legs of almost every FI. So I don't know if the Trump organization, organization, sort of one and the same, if they have a different view toward consumer protection. I think that they had a real problem, as did many people, with what CFPB had become. Even some CFPB regulators that I would talk to off the record were sort of dismayed of just how activist it became and not actually serving the purpose. So even before CFPB, there were consumer protection laws. And we didn't start protecting consumers when CFP became into existence. I think just that organization didn't achieve the mission, and that's why it's been effectively dismantled. But the question is, where will the protections come from? Because I think there still is the general view of protecting consumers. The question is, how do you do it more effectively? Is it just penalizing FIs, or is it also educating consumers, which is probably half of the equation? So anyway, I think there's less direction change and more just not regulating as much as they were.
Yeah. Paul, I know you have thoughts on this.
Yeah, I would, kind of along Josh's area, they've kind of dozed the OCC and FDIC. And, they've offered all these packages. So your senior guys have left or on their way out the door. So, now you have a lot of less experienced people regulating banks, and there's a lot fewer of them. And I think, and I'll defer to Josh again. I mean, he made a nice living off of trust preferred. I mean, think about publicly traded banks issuing debt. That's one thing. In this environment, you could issue 30-year money as a $200 million bank in the middle of nowhere. And because you're highly regulated and overseen by the Fed or the OCC or the FDIC, you could get that kind of capital. Recently, that capital has been sub-debt. But I think, any lack of regulation or the idea that people aren't being regulated as well as they have will have a huge impact on valuations, and will have an impact on banks being able, particularly non-public banks, from getting access to capital like sub-debt and senior debt for that matter. If you don't believe the numbers, you don't believe the regulators, you've really lost that credibility that sort of kept this industry different and distinct from everybody else.
And yeah. Paul, you've got evidence of that in the past, right? Look at the early 1980s after Reagan deregulated, right? And look at 2008 after basically the 2000s, deregulation. So we've had bad examples of banks going a bit wayward when they didn't have enough, I don't know, what do you want to say, curbs or safety guards from having them deviate too far from the mean.
Historical experience. I hear about the, 7.5% mortgage is too high. And, my first loan was 12%. My house I'm living in now was 975, and I thought it was a steal. Yeah. Now 6% of homeowners with mortgages have them at 4% or below. So affordability becomes an issue, but this is not the first time we've seen this. And it's not the first time we've seen inflation. And, early in my career, I worked for Paul Volcker, way down the path. But, his comment was, I'll quit raising rates when nobody believes inflation exists. That hit 21% interest rates, 13% unemployment. So the Great Recession wasn't so bad in some of our eyes.
Right. Yeah. We'll cover some of the macro stuff in a minute, but just wrapping up on regulation. And I know Basel III was a pretty giant reversal last year by the prior administration. What's going on with that? I mean, is there going to be a new rule? Are we even going to be part of this? Michael, you seem pretty well versed in this. What are you hearing?
Yeah, so there will be a new rule. Governor Bowman is leading the efforts for the banking regulators in terms of redoing the Basel III endgame. There were articles that came out, a day or two ago, or maybe at the end of last week, that suggests that the regulators are attempting to put out a proposal in the first quarter of 26. I think in our planning session, Josh, you're still taking the over on that one. But I think we're going to see. We're going to see a rule that's going to be significantly different from what the Biden administration settled upon, and we're seeing that there's a lot of uncertainty. Internationally, many countries are pausing their implementation of their Basel III endgames to see what the U.S. is going to do. And I think what's going to end up is we're going to go back to sort of an unlevel playing field in terms of various country regimes, capital regimes are going to be different, and so there may be some arbitrage people will be able to play based on those differences.
Difference meaning less regulated?
Well, I think differences in terms of, I mean, it could be more or less regulation, but I think more along the lines of how prescriptive, you'll have, how prescriptive will the rules be, and where will you have room for interpretation, and obviously risk ratings will be what the risk ratings will be, but there could be differences among countries there as well. So, I think there's a lot of uncertainty right now, and I think everyone is anxiously awaiting what this new approach is going to look like.
Yeah. I mean, speaking of uncertainty, tariffs are obviously creating uncertainty. Josh, how are tariffs impacting banks and the economy so far? You mentioned on our pre-call aircraft engines and so on. Could you give us some color on that?
Yeah, I mean, we're starting to see it, across the realm. I think it'll hit C&I lenders first, as the cost of goods sold goes up, and some of that can get passed through and some can't. Your average jet engine, on a small airliner or RJ or corporate jet. I mean, you're seeing tariffs for an overhaul that could be $200,000 or $300,000, where there were no tariffs before. And so, if you're sourcing parts from China, which is where a lot of parts actually come from aircraft engines, not Europe, huge costs. If you're into fly fishing, Shimano fly fishing gear is 15, 20, 25% tariffs. So, the costs of things are materially higher. I think we're seeing an implementation quarter to quarter of how that is translated into the economy, right? A lot of manufacturers stocked up on the componentry before tariffs went into effect. Well, that inventory eventually runs out. When that runs out, then the cost of good goes up, which either means it's going to get passed through into the economy as inflation, and then rates are not going to drop, or it's going to be partially or wholly absorbed by the manufacturer, in which case then EBIT's going to compress, in which case debt service coverage will be worse. So it will rear its head. It just doesn't happen overnight, right? Economic timeline is right behind geologic timeline. So it does take a bit before it rears its head. And I think people keep saying, well, it didn't rain today, so maybe it won't ever rain. That's just not realistic.
Paul, were they talking about tariffs on the earnings calls that you listened to? Did it come up very much?
I'm not sure the impact of tariffs has really hit. I mean, I think everybody went out and bought a huge amount of inventory. They're kind of working its way through. Where I noticed it are places like Caterpillar. They just reported lower earnings, but yet they produce tractors in 3 different countries. But 60% of their sales, I believe it is, are to China. So you look at them, and the secret there is they can get you a part anywhere in the world in 24 hours or less. So all of a sudden, what does that part cost? How fast can I get it? You bring in all these questions, and then I think what really doesn't get talked about very much is you've ticked off your best partners.
Yeah.
So if you're a corn and soybean producer in the Midwest, Canada, Mexico, South Korea, are your biggest buyers. And now they're going to look someplace else to buy those corn and soybeans. And all of a sudden, what's going to happen? And I think that's sort of the thing that hasn't quite played its way through. And I don't think it's played its way through on anything. I mean, there's so much confusion in the marketplace right now. I'm not sure I understand which way is up half the time.
Yeah. So we have this big, beautiful bill. It became law a couple weeks ago. What sort of impact are you guys seeing with respect to the economy and banks? How will this legislation improve, worsen things for banks and the economy?
Oh, I guess I could jump in. I think you'll see some over the coming quarters, initial small positives with all things being equal, because there's too many moving parts right now to identify what effect any one change has. So, slightly lower taxes for certain categories of companies, accelerated depreciation, which was now reset back to 100. So you'll see, I think, a short-term pop, but I think long-term it's going to be quite painful for both the economy in large and banks overall. I don't know any economist that is worth their salt that thinks that this bill was accomplishing anything that would be positive long-term. It sounds nice for the populace, but the reality is the economics don't hold up. So we'll have to see how it plays out. But I don't see this turning into anything that's going to be great and exciting and flourishing. I think it's a short-term pop for a long-term problem that is going to have to be dealt with over a long period of time. It's just the political parties that I knew growing up don't exist anymore. Right. There is no fiscal discipline seemingly on either side of the aisle. And fiscal discipline is what's required to run a country. Managing the fiscal policy by populism, which is what we're doing, never terribly good idea in any country ever in history.
Yeah. Are these rules, Michael, coming out with the big, beautiful bill? Is it the implementation going to take some time like some other changes, or is this pretty straightforward?
I don't think there's really anything straightforward that's going to come out under this administration. I think it's going to take time to implement many of the things in the big beautiful bill, and I think I definitely agree with Josh's sentiment that we may see a short spike, but I think in the long run, I don't see how things will be as rosy as the administration would have you believe. I mean, if you look at the America First provisions, and they wanted they would like the manufacturing to come back to the United States, and you have the tariffs that may make getting goods from outside the United States much more expensive. Will make it much more expensive, and the goal is to bring the manufacturing back, but it's going to take 3, 5, 7 years to build that kind of manufacturing capacity in the United States to offset the inability to get economically get the same things from overseas. So I think a lot of folks are taking a wait and see approach, and I'm not sure which way this may go.
Yeah.
And Michael, I mean, the aspiration, I think, is something we all agree with, right? It'd be nice to bring America back to a point where, people build things. But I agree with you. There's 3 aspects. One is the timeline. It just takes a very long time to build that infrastructure. 2 is we have a shortage of trained, skilled people.
Mm-hmm.
Right? Trade schools. I mean, if you want to make some part of college free, make trade schools free, right? We need people with trades and skills who can actually manufacture things. But then you have the question of the income disparity, right? You can manufacture things in the US if you're willing to pay a lot more for the goods.
Right.
But if you manufacture in China or India or Mexico or other countries where the hourly wage and the compliance rules, safety, et cetera, isn't there, that you can't get blood from a stone. So if we're willing to, have that Walmart item that costs $15 now be $30 or $45, yes, you can manufacture domestically. But you can't both manufacture domestically and get the growth without the cost of the product being significantly higher, or you're just putting more people in the poorhouse. Like, it's a zero-sum game.
Mm-hmm.
Yeah. I got a poll question. Sorry, a question in the audience. Matt Schmaltz. What is your opinion on the FDIC's proposal to increase the thresholds for financial institutions audits? Part 363. Likelihood that goes into effect quickly, time frame. Any color on that? Mike, Josh, Paul?
don't know if I have color on that. I mean, I think there is, and this comes back to what Michael was talking about earlier with Basel III. You know, we are the most unique banking system on the planet. That's just a fact. We have still over, 4,000 banks and what, 3,500 credit unions or more. There's no other country that comes into a fraction of that number of FIs. And so Basel III was really always meant to be for banks that operate internationally. And when you talk about an America First policy, the question will be, and this sort of comes to your point, John, should smaller domestic only banks be treated somewhat differently in scope and scale, right? The majority, by count, the majority of banks domestically don't have international operations, don't have FX, don't have consumer lending, don't have derivatives, they don't have capital markets groups, they don't have any of these things. So do you need the same level of regulation, frequency, scope, scale for banks that take so much less risk or have at least less categories of risk than larger institutions? I think my view is you should regulate them not as harshly so that they can operate and do the job of rehypothecating deposit to make local loans. So I can't give a specific answer to that question because I don't have a direct answer from any data, but directionally that question keeps being asked by regulators and by the industry. And I think there is going to be a push to loosen the reins on traditional commercial banks.
Yeah. We have a poll question on interest rates. How much do you expect the Fed to cut the funds rate for the rest of the year? None, 25, 50. Well, that should be 75 or more. My bad there. But let's hold for feedback from the audience. Michael, do you have any thoughts on that question, the audits, while we're waiting?
I think that's something that's not going to play out for quite some time. I think at the end of the day, it's going to be difficult to roll back the level of supervision for the smaller banks because of the overlay of deposit insurance. So, you need to make sure that folks still have confidence in their financial institutions, the safety and soundness of their financial institutions. So I think there'll be discussions. I'm not as certain that that kind of change will eventually happen.
Yeah. So the poll question, interest rate, this is interesting. I thought the consensus view was 2 rate cuts this year, 50 basis points, but at least this audience is looking more at 25. What's your view, Paul, Josh? What are we going to see this year from the Fed as we close the poll?
I don't think you're going to see any rate cuts. And for the mere fact that a rate cut is going to make inflation even more pronounced than it is. So if the Fed says they're not going to stop inflation, then the rates are really immaterial. People either have to believe in what Powell's doing or not. And I think, right now, what you're really looking at is a good case of stagflation.
Yes.
I mean, you've got some issues with interest rates, with, all of that can be just a mess. And I think Powell's whole reaction has been to, let's let go another 3 months and we'll see how it looks. Let's let it go another month and we'll see how it looks. And, right now, I'm not sure, if Trump wasn't president, they wouldn't raise rates right now.
Yeah,
I agree.
Just
I think
to
it's
fight inflation.
Yeah, I think it's between 25 and none because inflation hasn't really reared its head. You still have, in the absence of a rate cut, you still have reasonably decent economic profile. But I think stagflation, circa 1978 is what I'm fearing. Same as you.
yeah.
And it's a mess. There's no way out of it. You can't cut rates. You can't, get employment up. You're just kind of stuck.
Yep.
Yeah. Let's talk about private credit for a minute, Michael. Private credit continues to expand, continues to take market share from banks, whether you're looking at mortgage origination, mortgage servicing, CRE origination, consumer lending. Every area banks are losing ground. Even things like C&I and construction lending that we never thought private credit would really touch. Do you see private credit being regulated? I mean, are we a new administration or crisis away from private credit being regulated?
I think we're maybe a significant crisis away from it being regulated. I don't think there's an appetite to regulate that under the Trump administration unless there is some kind of intervening event. So I think, banks are going to continue to struggle competing with private credit to win that business back unless or until there is that regulation. Like I said, I don't see this administration doing it on their own. They may be forced into it if something happens. But other than that, I think it's another administration change before you may see it.
I think you have to ask the question of, when you say regulate it, like what is being regulated? When we think about banks, yes, they're very highly regulated organizations, but they're not really regulated as lenders. They're regulated as deposit takers, right? That's really the construct. It's because you're getting the impetus of federal guarantees on your liabilities. That's the distinction. When you're dealing with massive private credit companies, right, a BlackRock or pick whomever, the lending can be the same. They're still competing, with one another. The difference is that the private credit, if we call it, companies, they're not offering federal insurance on their liabilities. They're just getting dollars from pensions and institutional investors. And so as long as those institutional investors are allowing them to go do what they want to do, covenants, no covenants, X, Y, whatever, they'll compete both on price, but they can be more flexible and respond more rapidly to market changes, where a regulator always has to, or a bank always has to look over the shoulder for a regulator saying, if I do this, am I going to get in trouble? Am I breaking some rules? Because there's just books and books of rules for banks, where there really are almost no rules for hedge funds, asset managers, et cetera. So I do think it's a long-term, pretty serious problem. And I think it's probably more serious for regional banks and money center banks, because if you look at the kind of lending that a community bank does, small C&I, right, 1 to 4 family, which to a lesser extent, local CRE, those deal sizes are too small for, a $4 or $5, $6 trillion private lender to focus on. Like, they just can't spend the time.
Yeah.
So I think the smaller banks have less of a fear, but the larger communities, super communities, regionals, and money centers, yeah, I think that's why Jamie Dimon sort of, flipped his coin and said, yeah, we'll dabble in private credit. Now, how he does that, still being a bank, I don't really understand the comment, but we'll see.
I may be the only negative one here, but I don't understand how private credit can return the kind of money that their investors want without taking pretty high degrees of risk.
Yeah.
And with risk comes losses. And banks can afford a 1% loss, give or take. These guys, I think, are in different types of loans that are going to take that at a higher level. Maybe they can, do things, like a converted, debt to equity and play that game that banks really can or don't do. But I think the yields on these things just aren't enough to make most investors that attractive. And then when you throw a little losses in with a recession or something of that ilk, lending's just a really hard business. I've never been in a business where I lent money, I wanted it back, and the minute I got it back, I wanted to lend it again.
Yeah. Got a question. I know we're going to cover this, so it's a good question for our panel. What are the group's thoughts regarding the Genius Act and the implementation of stablecoin amongst banks?
Well, there's two sides to it. There's the question of, do banks issue either stablecoins or tokenized deposits? One. And two is, for the non-bank issuers and the markets, is that going to put pressure on deposit gathering? capabilities. And so, one line that I have not seen clarification on, because it's easy to use a term and it's, also easy to not define it, is what's the difference between a stable coin and a tokenized deposit? One you can pay interest on, the other you can't. Maybe it's how many exchanges they're on or how many decentralized ledgers. I don't even know. I don't know if it's been clarified in the Genius Act at all. But I think I keep hearing from banks a slow but growing concern that if you have these stable coins effectively taking cash and buying treasuries, you're defunding the banking system, which means local loans are not being paid, and that's very not consistent with an America First policy. Because buying treasuries or money market funds, that doesn't help any community. And I think there is a concern that it can start to drain off some of the liquidity. Now, I don't think in a $20 trillion banking system it's going to be the death knell, but it's a concern. Do banks become big issuers of stablecoins? I don't know. I think it's way too early in the game to really know how that's going to play out. But I don't think you can just put your head in the sand and ignore it either, because it is changing quite rapidly. And banks may be able to, if it pans out to the positive, it may make B2B payments something that banks can participate in, which they've been out of for a very, very long time. If they can do 24/7 settlement across all of their merchants.
Yeah, I think the payment side of it's really where it works, because it's just so cheap in relationship to what a bank would charge today to move money around. I used to work for Bank of America a million years ago. They made $200 million just in moving money from the United States to the Philippines. I mean, think about that. Now that money goes away at cents on the dollar.
Right.
The Genius Act, is that moving along, Michael, or where does that stand? I'm not that familiar with it.
No, I think that's moving along. I think the question is not going to be if we'll have stable coins, it's when. And I think banks are taking a cautious approach to it, but we already see a number of our clients looking into and developing stablecoin platforms, and so I think it's a when, not an if.
Yeah.
Michael, does stable coin work well because you can track the money at all points in time from start to finish?
I think that's the underpinning of it. Yes, it's different than the anonymized other cryptocurrencies that are out there. So I think from that perspective, that's why it may be more palatable to the banking industry than wholesale jumping into other cryptocurrencies. But we're seeing banks start to do that as well too.
Yeah. Well, we're at the end of our outstanding webinar. I want to give special thanks to Paul O'Connor, who I didn't have a chance to thank. He pinch hit on a few hours of notice, and really appreciate his contribution. Want to thank Josh and Michael as well. Anna, you want to take us out?
Yeah, it looks like we're all clear. You covered all the questions. So again, thank you guys so much for taking the time to be here today and present for our audience. I know we'll have another one coming up hopefully next month, so just stay tuned and we will get that webinar information out to you all. Thank you so much and have a good rest of your day, everyone.
Thanks, everyone.
Great. Thank you very much.